Picture this. You wake up one morning, open your banking app, and your balance says zero. Not low, zero. You didn't spend it. You didn't lose your card. You didn't do anything. It's just gone. Now, is that more likely to happen at a physical bank or a digital one? The answer might surprise you, because it's happened at both. And understanding why and how is the difference between choosing the right place to keep your money and handing it over to a system you don't actually understand. Meet Keisha. She's 28, works as a nurse in Atlanta, has had the same Chase checking account since college, pays her rent by transfer, splits bills on Venmo, buys everything on her debit card. 6 months ago, her nearest branch closed. And now, for the first time in her adult life, she has no physical bank she can walk into. Everything is in the app. She's not panicking, but she has this quiet unease she can't quite shake, like she's flying without being able to see the ground. Today, we're going to give Keisha and you the full picture. Physical banking, digital banking, what each one actually does well, what each one costs you, the one thing banks are quietly profiting from that almost nobody talks about, and which setup actually makes sense for your specific life. Let's build this from the ground up. Before we get into the mechanics, there's something we need to tell you about part 2. Someone lost $1,400 on a Saturday morning, doing everything right. We'll get to that story. And by part 3, you'll understand exactly how to make sure it never happens to you. That branch Keisha used to walk into, it's part of a much bigger trend, and understanding what was actually inside it, what it did that the app can't, is the first thing we need to get clear on. Since 2009, the United States has lost more than 15,000 bank branches, thousands of communities, many of them lower income, many of them rural, where the nearest branch is now a 30-minute drive away. So what does a physical bank actually give you that an app doesn't? 1. Human dispute resolution. If something goes wrong, a fraudulent charge, a frozen account, a loan denial, you can walk in, sit across from a real person, and make your case. That physical presence changes the dynamic. Disputes resolved in person are settled faster and more often in the customer's favor. 2. Complex transactions, business accounts, cashier's checks, safe deposit boxes, large cash deposits, notarized documents, international wire transfers. The app handles some of these, not all, and not with the same reliability. 3. Trust and psychological safety. Don't underestimate this. There are people of all ages who cannot bring themselves to trust an app with their life savings, and that psychological comfort has real financial value. A person who keeps their emergency fund under a mattress because they distrust digital systems is in a measurably worse position than someone using a physical bank they trust. Comfort with your financial system is not irrational, but here's what that building costs you: rent, staff, utilities. Traditional banks pass every dollar of that overhead straight to you in monthly maintenance fees, minimum balance requirements, and savings rates so low they're almost insulting. You pay for the building whether you use it or not. And here's something worth saying out loud, because a lot of people believe the opposite. A physical bank does not make your money safer than a digital one. Myth. Physical banks are safer because your money is actually there. Reality. Your money at any FDIC-insured bank, physical or digital, is protected up to $250,000 per depositor per institution. The building is irrelevant. What matters is 4 letters: FDIC. A high-yield online savings account with FDIC insurance is just as safe as a vault you can walk past. Check the label. That's your real protection. Now here's where it gets interesting, because digital banking doesn't just do most of what physical banking does. For some things, it does it 10 times better, and we mean that literally. The number is coming up in part 2. Stay with us. Here's a number that should reframe everything you think about where people keep their money. Chime, an online-only bank most people over 40 have never heard of, has more than 22 million account holders. No branches, no tellers, no vault you can walk past, just an app. 22 million people trusting their paychecks, their rent money, and their emergency savings to software. Is that reckless? Or is it actually smarter than the old way? Let's find out. Because one of those 22 million people had a very bad Saturday morning, and his story, coming up in part 3, is the most important thing in this entire video for anyone thinking about going fully digital. We said digital banking does some things 10 times better than physical. That wasn't an exaggeration, but there's also something happening in the background of digital banking that most banks would prefer you never noticed. We're going to cover both. Digital banking wins on fees, or almost none. Without branches to maintain, online banks can offer free checking with no minimum balance. Some reimburse ATM fees nationwide. Someone paying $12 a month in maintenance fees at a traditional bank is spending $144 a year for access to a building they may visit twice. Then there is the big one: significantly higher savings yields. This is where that 10 times better number comes from. In 2023, while Chase was paying 0.01% on a standard savings account, Ally was paying 4.5% on a $10,000 emergency fund. That's the difference between earning $1 a year and $450. Same FDIC protection, same deposit, $449 more every single year, just for switching apps. Speed and convenience. Deposits clear faster, transfers in minutes. Open an account in 10 minutes from your couch. Freeze your card with one tap. Real-time spending alerts. The app does in 30 seconds what a branch used to take 30 minutes and a parking spot to do. Early direct deposit. Many online banks release your paycheck up to 2 days early, crediting it the moment your employer sends it, rather than waiting for the official settlement date. For anyone whose rent is due the same week as payday, 2 days is not a small thing. Now, here's the part most banking comparison videos skip entirely, and it matters. That gap between Chase's 0.01% and Ally's 4.5%, it's not a coincidence. It's not an oversight. It is a deliberate profit strategy. When the Federal Reserve raises interest rates, as we covered last video, banks can now charge borrowers more, and they do, immediately. Your credit card APR goes up almost the same week the Fed announces a hike. But passing that higher rate on to savers, banks do that slowly, very slowly, if at all, because every extra percentage point they pay you in savings interest is a percentage point less in profit for them. Traditional banks are sitting on hundreds of billions of dollars in customer deposits. They are lending that money out at 5, 6, 7% and paying depositors 0.01. The spread between those two numbers is one of the most profitable positions in American banking, and it is funded entirely by customers who either don't know better or don't feel they have a choice. Online banks, because they have lower costs and are competing harder for your deposits, pass more of that rate through to you. The difference between 0.01 and 4.5 is the difference between a bank that needs your trust and one that already has your habit. Myth. Online-only banks aren't real banks. Your money isn't as protected. Reality. FDIC-insured online banks offer the exact same deposit protection as any traditional bank, up to $250,000 per depositor. Ally, Chime, SoFi, Marcus by Goldman Sachs, all FDIC-insured. Before you open any account anywhere, check for those 4 letters. That's your real protection, not the building. But here's what we haven't told you yet. Digital banking has a specific risk profile that physical banking doesn't, and one person, whose story we teased at the top, learned exactly what that risk looks like on a Saturday morning. That's part 3, and after it, we'll show you the 3 things that would have prevented it entirely. Meet Marcus, 26 years old, works in IT in Houston, switched to an online-only bank 2 years ago, attracted by the 0 fees and the high savings rate. Smart decision by any reasonable measure. Then one Saturday morning, he got a push notification, a charge of $1,400 at a Best Buy in Phoenix. Marcus was in Houston. He had never been to that Best Buy in his life. Someone had done a SIM swap on his phone number, ported it to a new SIM card at a carrier store using a fake ID. Once they had his number, they used it to reset his banking password via SMS 2-factor authentication. The very thing that was supposed to protect him became the attack vector. Marcus got his money back, eventually, after 11 days, 4 phone calls, 2 escalations, and 1 very stressful Monday at work. His bank's fraud team was responsive, but those 11 days, rent due, groceries needed, near 0 balance, were genuinely brutal. Could this have happened at a physical bank? Different attack, card skimming, check fraud, in-branch identity theft, all real. But the speed of a SIM swap, an account drained in minutes, is a different threat entirely, and it requires a different response. 3 things would have made Marcus's Saturday morning a completely normal Saturday morning. We're getting to them right now. 10 minutes, 3 settings. That's what stood between Marcus and a completely normal Saturday. 1. Switch your 2-factor authentication from SMS to an authenticator app. Google Authenticator, Authy, or your phone's built-in option. SMS can be intercepted via SIM swap. An authenticator app lives on your physical device and cannot be ported. This single change closes the exact attack vector Marcus fell victim to. 2. Turn on instant transaction alerts. Every bank, physical or digital, offers real-time notifications for every transaction. Turn them on. The faster you know something went wrong, the faster you can freeze the card and call the fraud line. Marcus's damage was limited partly because he caught it within hours. Some people don't find out for days. Don't be that person. 3. Never click a login link in an email, ever. If you get an email saying your account needs attention, go directly to the app or type the website address yourself. Phishing attacks work because the link looks legitimate. Remove the variable entirely. Never use email links to log into any financial account. 10 minutes, 3 settings. That's the difference between Marcus's story and a story where nothing happened. Okay, you now understand what each system does well, what it costs, and how to protect yourself digitally. But here's the question nobody's answered yet. Which one should you actually use, based on your specific life? That's exactly what part 4 is. 5 profiles. Find the one that sounds most like your life right now. Profile 1. Salaried, direct deposit, mostly cashless. This is Keisha's situation. Paycheck by direct deposit, rent by transfer, everything else on card, rarely touches cash. Go mostly digital. High-yield savings account online for your emergency fund. That 4 to 5% rate is too significant to ignore. Low-fee checking either online or at a credit union. Keep physical branch access only when you genuinely need it. Don't pay monthly fees fees for a building you visit twice a year. Profile 2. Freelancer or gig worker, paid in cash or check. Digital only will frustrate you a lot. Keep a traditional checking account at a physical bank or credit union for cash and check deposits. Open a separate high-yield savings account online for anything you're saving. Transfer between them. You get better savings rates without giving up cash deposit access. Profile 3. Building credit or recovering financially. Online banks are often more accessible than traditional ones in this situation. No hard credit check to open a checking account. No minimum balance. No fees quietly draining what you've managed to save. Start with an online checking account. Chime and Current both have products built for this situation. Layer in a high-yield savings account as you stabilize. Physical banks can come later once you have the balance to avoid their fees. Profile 4. Small business owner. Business bank is more complex to create currents, or payroll, multiple accounts. A banker who knows your situation when you apply for a line of credit. Physical bank or credit union for your business account. The in-person relationship matters when it's time to borrow. For your personal savings, still go digital. Keep those two things completely separate. Profile 5. Less comfortable with technology. Staying physical is a completely legitimate choice, but leaving $20,000 earning 0.01% costs you real money every single year. Even one change makes a meaningful difference. Stay with your physical bank for day-to-day. Ask a trusted family member to help you open one online savings account for your emergency fund only. You don't have to move everything. Just move the money that's sitting still and earning nothing. Remember that opening image? You wake up, you open the app, the balance says 0. That can happen at a physical bank. It can happen at a digital one. What determines whether it happens to you and whether you recover quickly when it does is how well you understand the system you're inside. Keisha's branch closed. For a while, that felt like something being taken from her. But here's where she actually lands. She's moved her emergency fund to a high-yield savings account earning 4.5%. Her checking is still at Chase. No fees, direct deposit, works fine. She has instant transaction alerts on. Her two-factor authentication is through an authenticator app, not SMS. And she visits a credit union branch twice a year for anything complex. Physical banking gives you human dispute resolution, complex transaction support, and the psychological trust some people genuinely need at a cost in fees and lower returns. Digital banking gives you better yields, 0 fees, faster access, and real-time control. With a different security risk profile you now know how to manage. The right answer for most people is not either or. It's a deliberate combination of both, matched to how your life actually works. And remember what we covered last video, the Fed raised rates. In a high-rate environment, your savings should be earning 4 to 5%. That only happens if you put them somewhere that actually passes the rate on. The Fed creates the opportunity. Your banking choice determines whether you capture it or give it back. Here's the version a 12-year-old could understand. Physical banking is like a safe bolted to your wall. Heavy, hard to get into. You trust it because you can see it. Digital banking is like a lockbox in the cloud. You can't touch it, but it's faster. It earns more, and if you use it right, it's just as secure. Most smart people keep both. Some things belong in the wall safe. Some things work better in the cloud. The mistake is letting habit, not thought, decide which is which. Your branch closing isn't the end of the story. It's just the moment you decide to write the next chapter on your own terms. If this video helped you think about your bank account differently, hit the like button. It takes 1 second, and it genuinely helps more people find this channel. Subscribe to Pennywise Planning. This is what we do. Take the concepts that feel overwhelming and show you exactly how they land in your real life. No jargon, no agenda, just clarity. Drop a comment. Are you fully digital, fully physical, or somewhere in between right now? And if you've had a fraud experience on either side, I want to hear about it. I read every comment. Your story might become a future video. Next video, what is currency? You understand where money lives and who steers the system. But what is money? What makes a dollar worth a dollar? Why does the number printed on a bill mean less than you think? And what happens when a country's currency collapses? And what does that actually feel like for ordinary people? That video is next. Don't miss it. See you there.